Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. You know, the markets have been going up and up and up and up for months, and I'm starting to see a theme in the comments and chats that relate to these videos, and that is people are asking, when am I ever going to see a bearish trade demonstrated? Well, today, that's exactly what we're going to be doing. We're going to be revisiting last week's approach, which is in and out of a vertical spread within a single week, but we're going to be taking a look at that through the bearish lens. We're going to be planning and placing a bearish trade today. I know for some of you, that might raise the hackles on the back of the neck with the markets being as strong as they are. We'll see how this one plays out, but it should be a good discussion in any case. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in. Great to see so many of you today. Hello there, Janelle and Richard, Greg, Ray, Scott, Sharon, Jackson, RTR, everybody else. Thanks for joining us week after week. We always do really appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. Just addressing any questions that I can't get to. Thanks for having my back there, Brent. And Brent and I would also like to issue an invitation to everybody watching. If you have an account on the platform known as X, you should be following your favorite presenters there. It really is the very best place to connect with us in between these live streams. You can find Brent there at Brent Moore CS. You can find me there at Cameron May CS. But let's get into this discussion. Of course, as we discuss these weekly approaches to trading options, they certainly carry risk. So this is important information related to risk. Bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set the agenda for today's discussion. If you're new here, you need to know how this thing works. This is a series of webcasts, and so we tie back to previous webcasts first. So the first thing that we're going to do is have a look at existing positions. Those are all going to be long vertical spreads or diagonal spreads. But we're going to talk about the potential management of those, maybe place some new trades. Then we're going to take a look at the markets, see what's going on with the S&P 500 as of the moment. Our hypothetical traders out there trying to make decisions about their vertical spreads or diagonal spreads. And then we're going to be planning and placing a new trade. And that new trade is going to be a bearish long put vertical spread that is going to be entered and concluded within a 1 week time frame. It's not the way we always do it, but last week, we talked about being in and out of trades within a single week, and we did a bullish trade. So this week, we're going to just take that same approach, but do a bearish one. So before we're done, we're actually going to be placing an example trade on the thinkorswim desktop platform. So let's get right into the discussion. Let's have a look at our existing positions. We have 4 that are active right now, but 1 that concluded since last week. It was actually last week's trade. We said we'd be in and out within 5 days. Well, it's been 5 days since we got into this trade. Trade's over. So let's see how it went. Let's go to our charts tab. And I want to have a look at what's going on or what has gone on with Apple. So here's what we saw happening last week. We saw that a downward trend had been broken, coming down from these highs. We were starting to break above that trend line. Also, a horizontal plane had been broken right about that 214, 215 level. So we got into a long call vertical spread. The 215 long call was purchased, the 217.5 short call was sold. So the preference there for the trader would be to be above 217.5 as we move toward expiration. That position was taken here, and you can see the very next day, we got a strong move in the right direction, and boom, that actually triggered our target exit for our Apple trade. So if we were to go to monitor and switch over here to our account statement, we can see last week's trade here. That was August 7th. We opened that position and then closed it, opened it for a net debit of $1.65, obviously setting commissions aside here, exit it for a 210 credit. So that's a realized gain of 45 cents, not net of commissions. Or in other words, about a 25-30% return in just an overnight trade. Now, that was a pretty quick turnaround. We got a particularly strong cooperative move on Apple, But yep, that trade is done. No further management required here. If you want to see the logic of that trade, let me make a suggestion here. If you weren't here last week, make sure that you're subscribed to our Trader Talks channel. If you haven't done that already, you can subscribe by going down the lower right-hand corner. But our Trader Talks channel on YouTube is where we house previous webcasts. So full title of the YouTube channel is Trader Talks Schwab Coaching Webcast. You can just look for that on YouTube. Then go to the playlists on our homepage. And if you scroll right down toward the bottom, we have lots of webcast series on a range of topics. This one happens to be closer to the bottom, long verticals and diagonals. If I go to that view full playlist for that series, there was that discussion, weekly vertical spread strategy, in and out in 5 days or less, with an example. It says in and out by Friday. Actually, yeah, I was talking about this Friday. We were actually in and out by last Friday. So let's go back here and look at our remaining positions. We have 4 positions left. We have AVGO. Now, with this one, this is a bull call vertical spread. Bought the 270s, sold the 280s. We'd prefer to be above 280 as we get closer to expiration. Well, guess what? Expiration is tomorrow. There's 1 day left on these contracts, and we are solidly above 280. Let's look at that on a chart. And then I'm going to do something to make some people nervous here. So here's AVGO. Let's here's our example position along the 270, short the 280. We'd like to be above 280 as we get toward expiration. We're looking for assignment at 280. We exercise at 270. That realizes the maximum gain here. We have 1 day to go. Now, this is almost certainly going to be a maximum gain trade. There is certainly a way that this could break down, though. If the stock were to sell off sharply, and if we were to come down below that short, and especially if we went down all the way down below the long, it's not very likely, but it's possible. That could reverse things. How much meat is left on the bone here? What we can do quickly to check is to look to see how close are we to a $10 difference between the current market prices of those two options. Looks like it's awfully close to 10 bucks. We're about 5 cents away from being right at maximum theoretical gain position. Now, the trader could just choose to exit, and if they're in a good liquid set of contracts, hopefully they can get a quick exit. I'm not going to do that. Ooh, look at that. They're at 10 bucks right now. 41.40, 31.40. That's $10. That's the best this trade can do, theoretically, right? I'm going to let this go. I'm going to let this go just to see, because I love having something to talk about if the stock reverses. Most likely it's not going to. Most likely we just wind up with maximum gain, but I'm going to let it go. All right, so GILD is a long call right now. This webcast series isn't called long options and long verticals and diagonal spreads. It's actually long verticals and diagonals. So what are we doing with just a long call? Well, this one actually started live as a diagonal spread. We've closed out the short, and now we just own the long. So here's what's going on with GILD. Doing great on this, $5,000 up on that long trade. We entered that back here. Now, since we entered the long call, we have had a few trades, couple that went against us. We've had 1, 2, 3, 4, 5 closed profitably, the short options. But we had an earnings announcement coming up, and we made a decision, no short call before the earnings. Let's not put a cap on that long call. That looks like that turned out to be a pretty good decision. We had a strong earnings announcement, solid reaction here. However, could be now that the stock has overextended itself. The long call may start to suffer for a little while. How about we sell a short call at this point? Let's go to the trade tab. Let's add a short call. How about for this trade? Let's go out to the next monthly expiration, the 19th of September. Those tend to have greater liquidity, not always, but typically greater liquidity than the weeklies. And let's sell out of the money. Now, for some traders, they might look at Delta as a gauge. Delta can give us the amount of leverage an option offers. You know, how much it might change on a $1 move on the stock, up or down. But it can also give us a rough approximation of the likelihood of a contract expiring in the money. Now, if we're going to sell a call, we probably want this to expire out of the money. So let's say we were looking at this 28 Delta call. about a 28, maybe 29% probability of expiring in the money. On the other hand, maybe a 72, 71% probability of expiring out of the money. So let's sell that one, the 125. That's going to be on our chart. Let me draw this in up here. I actually had to reposition the chart. That's going to be up here and goes out through this expiration. But we'd like this call, we'd like the stock to, it can rally, just prefer to stay below 125 as we move toward September 19th. So let's do that. 125, let's sell that call, creates that diagonal spread again. Now with this one, we only own 3 contracts. So as we go to place this trade, let's match that with 3 short contracts. The 19th of September, 125 calls, going to try to get, could be between 138, 144. Let's see if we can get 140 out of this. Anytime we enter a limit order, there's not a guarantee that that order is going to fill. We'll see. Going to try to get $1.40 out of these. That would give us $420 net, well, not net credit, but credit. The net credit would be $418.05 after commissions if we can get this filled as a minimum. It might be more than that. It just won't be less than that. So let's send that off. Yeah, RTR says it's been a nice trade on GILD. Yep. Now, if it collapses, we could see some of those profits start to melt pretty quickly, but we'll see. Let's send this off. And we'll let that work. It's going to be up here in our working orders. Trying to get $1.40. You can see it's at 141. All right. Actually, we sold that for 145. That was kind of a generous fill. That's okay. We'll take that. So our GILD short is now sitting down here on an unallocated. Let's right click on that. And let's move that to our long verticals and diagonals group. There it is. Now it's up here paired with that long. All right. So with Google, what do we have going on with Google? With Alphabet, another long call diagonal spread, bought the 180s for 155 days. They had more than that when we bought them. That's what we own though. Sold the 205s. They expire tomorrow. So we'd prefer to be above 180, but below 205. Where are we? Look at this. We're at 203 and change. Ooh, this is cutting it kind of fine. Look at that. There's our 205 short call. Looks like we've, for now, picked a pretty good strike. This is still out of the money. Now, assignment risk is still present, even if we're out of the money. It's not as strong as if it were in the money, but it's still a possibility. JM460 says, why not close that GILD position? The trader could do that. There are pros and cons to doing that. GILD seems like it net appears to still be bullish over the longer term. Maybe the trader thinks they've got 155 days left on that trade. Let's continue to play it out, or maybe they could just wrap it up. Pros and cons to both of those decisions. It's a legitimate question. Okay. What do we want to do with this 205 short call? Now, if I leave this alone and we come back and look at it next week, if this creeps up just a little bit higher, we're not going to be assigned if it's out of the money in our paper money. It could happen in a real account. Paper money would just allow it to expire worthless. But all it would take is a little bit of rally today or tomorrow to put this in the money. And whether we're dealing with paper or real life, we're staring straight in the face of assignment at that point. Very, very rare exceptions if we're above our strike. So in this case, what do we want to do with this thing? I think there maybe I'm tempted to just let it go just so we can talk about that, because I like to have these painful things happen sometimes. Now, painful is determined by what the stock does after assignment. But RTR says close it. We could roll it. What does roll mean? It means get out of this one, get into another one, either at a higher strike or a more distant expiration, or combination of those two. I think what we might do here, let me look at that chart one more time. Yeah, you can see this has run up really far. Now, another thing that we could do is just close the whole thing. I think that's what some of the votes are coming in as. Just close the whole thing. Got a nice profit going. We've actually just about capped out what this thing can do for us for this expiration. Greg says rolling it would be a good exercise. All right, let's do that, Greg. So rolling means maybe we move our strike up, maybe we move it further out in time. I wonder if we went out here, what if we gave this some more breathing room, maybe went up to 210 or possibly higher? We know that to buy it back would be around, right now, around $1.40. That would be a little bit less than we received for it originally. So a small realized gain if we did that on these short contracts. It's not a huge profit. That's okay. The long call is actually sitting on quite a nice profit. But yeah, let's maybe roll this out. Maybe what we can do is roll it up to a higher strike, out in time, lowering the risk of assignment, at least for now. It could still continue to rally. But what would we get if we were to go out to 210, maybe even 215? If we were to go to September 19th, the 215 strike, well, if we paid $1.40 to get out of the current one, and then received around $3.40 to get into a new one, that would be for a net credit of about $2. I think let's do that. Let's do that 215 for the 19th of September roll. Okay. Here's the way that's done. I'm going to go to our monitor tab, right click on the short strikes and create a rolling order. And that's going to say that we're selling a calendar. That's really sort of what it is at the moment. All that means is a calendar is getting into a long option and a short option on the same side, call or put at the same time, but at the same strike. In reality, what we're doing here is buying out of the ones that we're in, the 15th of August, 205 calls, but we're selling into some new ones. And these, we need to tell the system which expiration we want. Let's go for the 19th of September. Those tend to have a little bit stronger liquidity than the weeklies. And how about we go to the 215? So now instead of having an obligation for somebody has the right to buy shares from us for $205, they'd have to pay us $215. About $10 more of upside breathing room there. And it looks like we might be able to get 207 credit, a 209 credit. What if we just said we're willing to settle for a 205 credit on that roll? Let's click confirm and send here. We're going to sell this. It's now calling it a diagonal. It's not really a diagonal. It's exiting one into another, rolling. As we roll, there's one of the drawbacks of rolling. First of all, it leaves us in a position that carries its own risk potential in addition to its reward potential. It also multiplies the number of commissions the trader is paying. We have to be aware of that. But let's see if we can do this for that credit. Let's send this off. Yep, and instead of a 205 credit, we did it for 211. So we're done with that. I'll summarize the profit that was made on that short on this one. It wasn't huge, that 205 short. Probably made 25, 28 cents, something like that. But we're done with Google. And then we have Nvidia as well. And it's very similar. Actually, this one's even a little bit stronger probability of assignment. 145, 180 call diagonal. We'd like to be below 180 tomorrow. We're at 182. I need to roll this one as well. Nvidia. Now look at this. We've rolled this one before. This one was rolled for a loss. I'm guessing we're probably going to have to roll this. No, not for a loss. Nope. Sold it for 405. It's worth 284. So that we're looking at maybe $1.20 gain-ish, depending on if we're able to fill what we fill for. But we might need some more wiggle room here as well. Now I'll have to say, with this so close to expiration and in the money, there would be an elevated risk of early assignment again in a real account. This certainly could have been assigned already. We have to be constantly aware of that. Oh, what do we have right around the corner? Ooh, what do we have right around the corner? You know what, with this one, with that earnings announcement, I think what we'll do, I'm going to hold on to this call, and we could just close this whole thing. What do you think? This has been a profitable trade. So we've made about $15.5 unrealized gain on the long. This one, we might be adding about another $1.20, $1.25 gain on that short position. So overall, maybe about $18 up on these two positions. But there was one other. We had a short that was closed out for $2.65 loss. So overall, maybe we're up about 15 bucks, and you can see why the stock has been quite cooperative. How about for this one? Let's just say our trader has decided they're fine with the gains that they have made. Let's wrap this one up. Paul says let's avoid earnings. In this case, let's do that, Paul. Not every trader makes this decision, but I'm going to right click on this. Let's create a closing order and let's sell this diagonal for what we can get for it. Looks like it might be around $43.50 just to get out. Let's see if we can get out as quickly as possible. I'm going to still put in a limit order. It's not a guarantee that we will exit right now. I'm going to back off on this and say that we're willing to exit for a 43.40 credit. All right, but let's click confirm and send. Sell this diagonal for 43.40. There is a commission to be paid. That'll chip away at the net credit received if we're able to exit. Let's send this off. Now, JM460 is saying open a put diagonal, just do a straddle strangle swap. That would be getting outside the scope of this series. Not that I'm saying it's inherently a bad suggestion. It's just that my series title is long verticals and diagonals, and therefore I just stick with those, and I tend to keep them separate rather than like if I were to teaching a webcast series on short spreads. Technically, I could do an iron condor, but that's sort of getting outside the defined boundaries of. I like to keep these discussions targeted. Good suggestion, interesting suggestion though. In any case, we are done with that trade. Exited. So net a nice little trade there, but that leaves us with a new trade to plan in place. And we've had a lot of bullish trade after bullish trade after bullish trade for the last several months. Let's do something bearish, and let's talk about the market conditions in which we are going to be doing. So here's what's going on with the S&P 500. We looked like we might be threatening for all-time high close, and we still could. Looks like we might be backing off from that right now, but markets have been very bullish. You can see why we've had so many bullish discussions over the months. But yeah, let's look at things from the other side of the coin, and maybe here what we'll do is put ourselves in the shoes of a trader who thinks that there might be a pullback of some substance here within the next week. What do you think? Looking at how the S&P has moved, not just over the last several months, but also just over the last 2 weeks, if you were to assign a probability in your own mind, there's no right or wrong answer here. Nobody knows the future. What do you think the odds are that we get at least one good size red candle within the next 5 trading days? Maybe our trader thinks that's about to happen. Maybe they think we're a little bit top heavy. And if we could just be quick, get that one down day and out, that's the premise for the strategy. So we're going to be building a bearish trade. We're going to be attaching a quick exit, just like we did with our bullish trade last week, and seeing if that works. But it's going to be associated with a fairly strong risk. So we have to be aware of that as well. So I've sort of pre-selected a stock as an example. We'll see if it's cooperating even right up to this moment. But I want to talk about how a stock is selected for these sorts of trades. Now, traders can have all kinds of different approaches, but when trading very short-term options, liquidity can be a real driving consideration, because if we're trying to trade illiquid stocks that are hard to get, or illiquid contracts that are hard to get into, hard to get out of in a very short time frame, that's tough. So sticking with probably the most liquid stocks out there, the most heavily traded stocks is what I'm talking about, and the options associated with those, that could be an initial pre-qualifier. So I'm going to be using Procter & Gamble. Now, another consideration is, what has the stock price been doing? Has it been more bullish or more bearish? And let's say that we have a technically oriented trader here, and they notice a few things about PG. First of all, we have that earnings announcement in the rearview mirror. Secondly, on a 1-year chart, price has really been coming down. Now, it's been going through a series of peaks and troughs, but we run up and pull back and run up and pull back, stair-stepping downward. And it looks like most recently we've come up and started pulling back again. Now, additionally, it's kind of interesting that yesterday's high, what does that coincide with? Well, that was actually coincident to the 12-month previous lows. So a previous price floor might be acting as a new resistance in the very short term. And we're talking about if a trader is getting into and out of a position within a period of a week, their timing, the word that I've been using recently, needs to be pretty tactical, meaning it needs to be fairly precise. Now, precision doesn't mean it's going to work out every time, but we're looking at this to see, has the stock been behaving not just fairly well recently, but precisely as the trader would hope, very recently. And here, it looks like we've rallied up to an apparent price ceiling. We pushed off that. It's a price ceiling across two planes, the horizontal plane and this diagonal plane. And even today, we started to gap down. So that's the view from a 1-year chart. And just like we did last week, a trader on such a short-term time frame may take a closer look at that chart. So let's switch up our time frame here from the 1 year, 1 day. Let's see what's been going on over just the last 5 days. Now, as I do this, we're already aware now of these. Let me clean the chart up. Right click. Let's clear the drawing set. So as we move to that shorter time frame, it's not at all cluttered. Let's go to that 5-day, maybe 5-minute chart. And here's what a trader might notice here. First of all, we've had some strength over the last 5 days. There was an upward channel or an upward trend line established here. What happened right there? Just a day and a half ago. Strong gap down. Now, when a trader sees a big gap down, commonly, there's an assumption that the bottom side of that gap is likely to act as a new price ceiling. It looks like it's doing a pretty fair job of that at the moment. So we're not just doing what I typically do and look at maybe a 1-year chart, possibly framed within a weekly chart, something like this. Here we're looking at the 1-year chart and then zooming in and looking at a shorter term time frame. So let's say that our trader is satisfied that this uptrend has reversed. It looks like there's an immediate area of resistance, and now we kind of have a downtrend in effect. And what we're hoping for is to get just a continuation of that downtrend, maybe for a day or 2 or 3. But we're going to be planning a trade that is not patient. We're going to be getting in and out within a week on this premise. So let's build that trade. So how might that trade be placed? Well, we've talked about one of the potential concerns of a short-term trader, and that is liquidity. Another concern is that if we go to a short-term expiration, so how about, let's do this. There are contracts expiring tomorrow. That's within a week, but that's cutting it pretty short. Let's go out maybe to this next expiration. These are going to be weekly options, and weekly options, they tend to not be as liquid as the monthly options. The spread between the bid and the ask price can tend to drift a little bit wider as a result. So there may be an even stronger emphasis for a trader who is trading weeklies to look for the most liquid stocks out there if we're doing these very short-term turnaround kind of trades. But let's look at this 8-day contract. And if we look at the put side of things, we're going to be building a bearish put spread. I look at those spreads. Okay, they are penny spreads. They're penny spreads. That's an indication of pretty good liquidity, pretty strong liquidity. Still fairly wide, though, to be honest. You look at that 157.5. That's still a 25-cent spread on a $3.50 contract. It's about 6 or 7% spread. That's something I want to note here. But another issue for these short-term trades that we just have to be aware of is that it'd be great if we could do some, let's say, deep in the money trade that has a high probability of maximum gain. The problem is we can't go very deep in the money before there's really just no meat left on the bone on those trades. So like if we went to this 160, 162.5 vertical spread, look at the difference between those two prices. It's basically $2.50. Well, a $2.50 cost on a $2.50 spread leaves nothing for profit. So a lot of these sorts of trades are going to be done quite close to the current price of the stock, which means the trader needs to be quite confident in their timing. And They may be giving a lot of emphasis to what's been happening in the very short term, like a 5-day chart. So with this one, how about we look at the 155, 157.5 put spread? What we're going to be doing explicitly here is buying the 157.5. It looks like it's going to cost us around maybe 375. Selling the 155, which might bring in about 205. The net cost there might be around about $1.70. Let's explore that over here mathematically. Let's open up our scratch pad. And this is going to be our example trade, which is going to be just like last week, a sub 5-day. Now this is going to be a long put spread. Let's make this bold. Let's widen this margin a little bit so we can fit the whole thing on one line. There we go. And it really begins conceptually with buying the put. So we're going to, in this case, we're going to buy the 22nd of August 157.5 put. That looks like that's trading between 370, 385. Let's just call it 380. I don't know what's going to ultimately wind up costing us, but this allows us to to sell shares for 157.5. We have that contractual right. For the next 8 days, we can sell shares for 157.5. Those shares are only worth 154. But at the same moment, sell the 22nd of August, 155. Now, RTR says, why set up with only 2.5 wide? Good question. We could go wider. What that would do is, now let me finish this, and then we'll quickly do some math on a wider spread, look at the pros and the cons there. Okay, but let's sell the 22nd of August 155 put. That looks like we might retrieve still around 205. And here's the net deal that we're left with between our two contracts. We're spending 380 for the right to sell shares for 157.5. We're collecting 205 with an obligation to buy shares for 155. So if both of these contracts are ultimately assigned and exercised, let's say we're required to buy shares at 155 and then we sell those at 157.5. Well, that would be a $2.50 profit if this were a free trade. Not a free trade. It's actually net going to cost us about $1.75. So $1.75 to possibly turn into $2.50. So that kind of tells us the reward and the risk scenario here. So what is the net debit for this trade, which is also equal to the theoretical maximum loss? Going to be about $1.75. What does that leave over for theoretical maximum gain? Would be, well, if we made $2.50, but we spent $1.75, leaves us with 75 cents of reward potential. So there's your trade. We can make, if this trade goes well, we could make up to 75 cents. Now, obviously, commissions need to be deducted from that. We could lose up to $1.75. How do we make or lose those? Well, this is a bearish put spread. We'd prefer to be below 155. Well, guess what? Stock's already below 155. It's at 154. And if it keeps going down, this trader has the motivation to sell us shares at 155. We have motivation to sell our shares at 157.5. That would be our $2.50 gain minus the $1.75 cost for the trade, leaving us with our 75-cent profit. Max loss is incurred if the stock rallies and these contracts expire unassigned and unexercised. Then we just lose our investment of $1.75. So that's it. So the question was, what about going wider here? Well, going wider, let's say that we bought the 157.5, but we sold the 152.5. Well, that, first of all, it brings in a smaller credit, requires a larger move. It has a lower probability of success. Where would the stock need to be if we went with that wider spread? it would need to be below 152.5. It's not there yet. It still has $1.50 of work to do. With only a week of movement, where we're already shaving it pretty close, that trader, there are potential disadvantages there. Now, we could have gone maybe deeper in the money. That's going to cut into the potential for reward. Now, yes, going wider brings in a smaller credit, but it also allows us to make a larger gain if we get there. Instead of having to buy the shares for 155, we'd only have to buy those shares for 152.5. That would give us $5 of reward potential to net against the cost of the trade. So there are pros and cons there. We don't have time. Clock's ticking on this webcast to explore that further, but hopefully that little short summary at least gave you some food for thought. In any case, let's place this trade, but just like last week, let's have a plan in place to take profits quickly if they occur. Let's have a plan in place to try to trim the losses. So let's place our trade, and it's going to be that 155, 157.5. I'm going to come up here where it says spread single and change that to vertical. And we're going to click on the ask price to create the buy order. Looks like, let me hide this left column. We don't need that anymore. Looks like it's going to be around $1.70. Let's say we're willing to spend that $1.75 to get into this trade. All right. So let's talk about taking profits. That's the fun part. And then we'll wrap it up with taking losses, the not so fun part, but we have to be aware that's a possibility. Let's say we're willing to do 10 contracts here, spend a total of $1,750. Well, I'm going to change this from just placing a single order. But let's choose that first trigger's OCO, which is going to allow us to put in 2 exit orders, one to take profits, the other one to take losses. So I'm going to right click. Let's create an opposite order and talk about taking profits. So if we're getting in for $1.75, we know that on a $2.50 wide spread, the best theoretically we could do is exit this for $2.50. Well, as we discussed last week, maybe a trader just wants to get in and out before expiration. And maybe if they could just get 50% of that gain that we calculated, 75 cents. Let's try to get at least 50% of that. Well, what would be at least 50% of 75 cents? That would be if we could make at least 40 cents. So if we're buying in for $1.75, let's say the trader wants to get out if they can exit at what would that be, $2.15? Buy in at 175, sell at 2.15. That would be a 40-cent credit, not 75 cents, not the full return, but at least half. Well, in last week's trade, we got more than half of the potential gain of the trade, not in 5 days, not in 6 days, but in 1 day. We'll see. Could do that again. That's our plan, to take profits if the stock, well, if it just drops some. If we get closer to expiration, combination of those factors could give us that exit. But at the same time, let's come up here and right click and talk about taking losses. Let's create one more opposite order. This is going to be our stop order. Stop the bleeding. And this is if we've spent $1.75 and the stock is going the wrong direction, which in this case would be up. This is a bearish trade. We want to be down below 155. But what if we started going up? What if we went up to 155 and we started going up, 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 up? This is a 5-day chart. It looks like we'd be going up forever. Let's look at it on a 1-year chart. It makes it a little bit easier to visualize this. So let me right click here, clear our drawing set. If our stock rallied from where it is right now and got up to here to 157.5, that would be above our vertical spread, and we would then be in position if we let it get to expiration. That's maximum loss. Let's put in an order to exit. If we even get there, forget it. Let's just be done with the trade. With this one, let's go to our little gear icon and add a condition. Here we're going to sell to stop the bleeding. Good till canceled. If PG market value gets greater than or equal to our upper strike. So we were at 157.5. There we go. Let's click save. Let's click confirm and send. All right. Now, let me hold on a second. I want to take a look at this again. Don't need a stop price in there. In any case, let's click confirm and send. We're going to buy the 155, 157.5, 155 long put spread for $1.75. We're going to sell that at a 215 limit if we can get it. And we're going to have a stop attached. We're just going to stop if the PG market value gets at or above 157.5. Oh, that's what I'm doing. Oh, yeah, I get a little bit ahead of myself. This is what I wanted to do. That's what I wanted. Yep, I'm blending my my orders. I don't think I've made that mistake in 20 years. Sometimes I get a little bit excited in explaining these details. Yeah, we want to sell at the market value. My apologies. We're not using a stop here. In this case, it's triggered just by market price of the stock. We don't know what the value of those options is going to be if we ever get above 157.5. So attaching a stop qualifier, that's tough. So what we're doing here is submitting a market order to just exit at whatever the market value of that spread is if we ever get to 157.5. There we go. So let's save that order. In any case, this is going to effectively act as our stop, but we don't know the full extent of that bleeding. What we do know is it should be less than maximum if that's triggered before expiration. In any case, that's why we always read our order confirmation dialog box to make sure that the order makes sense to us. Buying that vertical, 157.5, 155 put spread at 175. Going to try to close out for a 40-cent gain at 215, or sell at the market price if PG stock value ever goes above 157.5. There we go. Now, a couple of things to bear in mind. Due to potentially wide markets or liquidity risks at the time of activation, this order may be manually substituted with a limit order upon activation and worked until filled. That's referring to essentially our stop order. Please note that you've selected a weekly option series, and yep, these are weekly options we're trading with a non-standard expiration date. They're not the third Friday of the month expiration. And we'll send that order off. Let's see where we're trading right now. Oh, okay, I said that we were willing to spend up to 175. We got in for 174. Perfect. Guys, we have accomplished what we set out to do today. I wanted to sort of flip the script. We've done a lot of bullish trades recently. We've had some requests for some bearish trades. So we've planned and placed the bearish trade to be in and out within a calendar week. We'll revisit this next Thursday. If it's still here, it's still a possibility. We'll decide what to do with it then. But I hope this has been an interesting discussion for you, looking at things through a different lens. I'm going to let you go enjoy the rest of the webcast for the rest of the day. I also want to invite you to join me in my other webcasts sprinkled throughout the week, but a couple of reminders of some additional resources that you have outside of these live stream webcasts. Number one is to make sure that you have subscribed to our Trader Talks channel on YouTube, because this is where we house our archives for previous webcasts. Go to Trader Talks Schwab Coaching Webcasts, click on the playlist, and you can find all the previous webcasts listed there. Of course, you can also join our live streams here. You can do keyword searches for specific topics of interest right there. Now, another thing is to make sure that you're following Brent and me on X. Let me make sure, Brent. I don't think we had a survey. Nope. Yeah. But in any case, Follow Brent and me on X. You can follow Brent there at Brent Moore CS. You can find me on X at Cameron May CS. It is the very best place to connect with me in between these live streams. The producers actually watched me before the webcast launched. I was on X replying to some replies to my posts. So love to see you there. Guys, also thank you to everybody who has clicked the thumbs up. I can see 165 people watching, 70 likes. If you've enjoyed a webcast, make sure you click the like button. It sounds like applause to your presenter. It also gives us a boost in the YouTube algorithm, helps more people find these webcasts. All right, everybody, thanks for giving me your time today. I'll see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.